Kyle with how real estate changed my life. And if you've listened to any of my podcasts up to this point, I basically just talk to people and learn from them on how real estate, either investing in it or being involved with it, has changed their life, obviously for the better. And one of those is Jimmy here, and Jimmy Edwards. He was on a previous podcast and just kind of talked about how he got into real estate and where he's at as far as syndications and such. Now, I think it'd be good because we've gone through a whole bunch of podcasts of just kind of what's out there. I think it'd be really good to kind of dive a little deeper into Jimmy's story and what he's doing right now, because what he's doing is very fascinating. Not everybody understands what syndications are, and I think Jimmy's got a really good story and a really good track record and can explain what a syndication deal is, who is it ideal for, how do you find the ones to get in on, and what do you expect out of them? So I think we're going to dig a little deeper on this one and get real nuts and bolts on it. But with that being said, Jimmy, welcome again. I really appreciate it. I think a lot of people listened to your first episode that you're on, and I know that you're one of the people they talked about. I think most of the people they liked your beard, and then now they're going to see the second episode. There's like, where's the beard? Like, where's the
What happened? Who is this guy?
yeah. So, but no, tell us. So you already told us your story of how you got
Yeah,
into real estate and got into syndications, but let's talk about syndications and kind of why you were drawn to them, and then let's dig a little deeper into that.
yeah, for sure. Yeah, so thanks for having me, by the way. Honored.
Absolutely, I love talking to you. So it's
Yeah,
hard to put a camera on record because I think a lot of
yeah,
people.
yeah, we have some good conversations. So, yeah, I mean, I've been doing real estate since 2006 and started flipping houses 2013 full time. I was good at finding deals, always would run out of money, and kind of was like mini syndicating those deals, right? Like I would partner with people that would put up the down payment. I would get the loan, I would do the rehab, and then we'd split the profit. And we did really well through that. And then probably 2017, I learned about apartment buildings, and I learned that not everyone is owned by a giant corporation. Some are mom and pop, single owners, but then others are group purchases, which is called a syndication. And we did a little 16 unit deal and then another 100 unit deal, and we've done four or five full cycle deals where we bought them, rehabbed them, improved them, and sold them for a profit, and then went on to the next one. And what I liked about apartments was, you can kind of force the appreciation, and in single family, you're mostly held to the neighborhood values, right? So, if you buy a $200,000 house and you're in it for 20 grand a month, that doesn't make it worth $1 million, right? Well, in apartments, it kind of does. And so that was super attractive to me. And then I learned, always thought, well, shoot, how am I going to be able to do a big 100 unit deal? And then I learned about syndications, and syndication is really just crowdfunding. It's pooling your money together with friends and family, and in order to, buy the deal, right? So most deals in this environment, you're probably getting 70% leverage. So, let's just talk big numbers.
Yeah.
On a $10 million deal, you get a $7 million loan that's based off of current cash flow, and then a lot of times projected income, right? What you're going to do to the property to improve it. And so you need $3 million. And so, we've done that multiple times, and really we've built up a database of friends and family that have wanted to get involved, kind of saw what we're doing. And there's anywhere from sometimes investments as 25,000 up to 3, 4, 500,000, and it's really just a bunch of people pulling their money together. What I like about it is, you're helping your friends and family make money. Typically our goal is to roughly double our money in 3 to 5 years, right? And so, kind of the pitch is allowing our friends and family to invest alongside of us. We're putting our own money in too. And not really doing much, hands off.
And here's the
I've
thing is people hear that double your money thing in 3 to 4 years and they don't believe it because
yeah,
it doesn't exist in what most people know as investments.
right,
So can you explain how that double your money thing works, like nuts and bolts? You don't have to do it now, but maybe later in the conversation, because people need to
sure,
understand that is for real. It's not
yeah,
fake. It's not make believe. It's not snake oil salesman. It's not some guy on TV at 2 o'clock in the morning telling you to send him money and he'll send you more back. Like this is for real nuts and bolts on Excel spreadsheets, HUD ones,
yep,
settlement statements, for real
yeah.
stuff.
Yeah, 100%. And it's the deals that we look for, and it's probably why it was a little more easy for us to transition into it is because it's very similar to a house flip, right? Like we're looking for something that has a value add component, whether it's physical distress or operational distress, and not always distressed operationally, but maybe inefficiencies, right? And so, we model a 5-year plan. We do tons of research. We have tons of tools that gather data. We do an on-foot market survey. We walk the comps. And then, as you do more deals, you really understand, you know, how clean you can operate a deal, where you can push rents and where you can clean up expenses. And, sometimes the market is helpful and sometimes, it's a little bit slower, but at the end of the day, it really comes down to, building a community where you're making it nicer for the residents and they want to stay and they want to invite their friends. And, similar to your business, resident retention is one of the most important factors, right? And so a lot of times when owners kind of start running out of money, they stop doing work orders and then vacancy goes down. You can't charge as much rent. So like we really focus on resident retention, work orders, community. We have events and all those things. So it's kind of breaking it down, of that, let's say double your money, just because it's easy. Usually a portion of that on a 5-year plan is cash flow, right? And one of the reasons that I like the apartment business is that while you're flipping it, you have tenants paying, covering your expenses, right? Where some houses we flipped, if it took a long time to sell, it killed us because there was nobody in there paying rent. So as we decrease expenses and advance revenue, it creates cash flow, right? Over what our expenses are and over our interest payments on the loan. And then so a portion of that is cash flow, right? So you have, probably 30 to 40% cash flow over, 5 years. Usually it's, 5, 6, 7, 8%. And then the other half is back in profit, right? When you sell it for a profit. So, we've had deals that hit, right on the double your money. And then we've also had some deals that did like 300-400%. And it just, part of that was finding a good deal. And part of that was, having the market help us a little bit. So yeah. What else?
All right. Well, no, I gave you a couple of questions I wanted to kind of hit on
Yep.
before, and we kind of talked what a syndication deal is. Maybe we can go in and explain a little bit more about the benefits of investing in a syndication deal versus doing it themselves or putting
Sure.
your money into a REIT or something of that nature. Because I
Right.
think people think, oh, well, I'll just put, if I'm getting apartments, I'm going to go put my money into an exchange traded REIT, and it's not the same. So
No.
kind of tell us what the benefits are to a what we'd call a passive investor, a limited
Sure.
investor, limited partner.
Sure, sure. So, and a little bit of why, I got really into real estate and really into apartments. I always thought that it was, to your point, big REITs and big corporations that did all these things. And then I learned out about apartment syndications, and we can maybe talk about that structure here in a minute. But, if you're invested in Apple and Steve Jobs dies, or if you're invested in some giant Blackstone and they decide they want to shift, then it's not always you don't always have close relationship to the CEO, right? And so, for these syndication deals, we like to build relationships, and that's one of the most important things. And it really a lot of people that end up investing with us have either gotten into real estate or wanted to get into real estate. And maybe they had their first rental property, and realized just how much time and energy that it took to do that deal. And then sometimes that had to replace an AC unit, and most people don't just have that money, sitting around. So getting into the syndication is essentially investing, but not having to do really any of the work. But you also know us as the owner operator, right? As opposed to some big corporation.
And there's a real participation level in the return too. So it's not like they're getting crumbles off the
Right.
table. They're actually a big part of the return.
Yeah. Yeah. 100%.
And
Because
what do they typically get in return? Let's say I'm just a random guy. I'm giving you $50,000. You're going to do a deal. I come in as a limited partner. You're the GP. What kind of expectations could I realistically expect? And I'm not talking about maybe a deal that you got right now, but like in general terms, what would you expect?
yeah, I mean, probably on a deal like that, you would get, a couple grand a year in cash flow, and then make the rest up on the backside. So, I mean, in most cases, you put in 50 grand at the end of the deal, you're going to have 100,000 in your pocket, in your bank account. So, I mean, it's pretty straightforward. I mean, we do have, there's a fee structure, right? But I mean, we couldn't do it. We couldn't do these deals without our passive investment partners, right? So, I mean, it's we really want to make it, beneficial for everybody, right? So, the bigger deals that we do, the more efficient you can get, right? So, as you get up into 75, 100 units, you have more people at the property level to maintain, the community. So, if you have smaller fourplexes or 10 plexes, those can be good deals, but you have to, more there's not someone there at the property in most cases, right? So as we get into bigger deals, it's easier to turn a profit in most cases. So yeah, I mean, it's everyday people. I mean, you'd be surprised how many deals, how many apartment buildings, even 300 unit A class deals are put together like this.
Well, I get emails being invited on groups that, they're over 1,000 units and even
Yeah,
new construction or rehab ones. Like
yeah,
it's a little of everything. And some of these are huge. Like there may be more than just 20 people on a deal. There may be hundreds and hundreds of people on a deal.
yeah, yeah.
So who qualifies to be able to put money in on a deal like this? Could just any kid that works at Starbucks hand you a check, or do they have to have certain qualifications?
So most of the deals that we do there's two different kinds of deals. We have to register with the SEC, and there's, certain things that we have to do. And there's two ways. One is you have to be accredited, but you can go out and advertise. And then the other way is you don't have to be accredited, but I can't run out there and, put billboards up about my deal.
Right.
And that's typically the way that we've gone and the way that we like to go. It forces you to build that relationship. In my opinion, has always been, I'm going to have a better opportunity to find a good deal and raise the money confidently with people that I've built relationships with, right? So, putting my advertisement up somewhere, I don't, will strangers get in that deal? Maybe. But again, I'm probably better with relationships and then referrals, right? We can take referrals. So under that, code SEC 506B, you don't have to be accredited, and really anybody can get in the deal, but you do need to have some sort of, they call it a sophisticated investor, right? So, you need to understand the risks, and, it probably should not be, the last money in your bank account, right? Like, it is an investment. There are risks involved.
It's not liquid.
Need to understand the deal, right? So, we usually have an investment prospectus, and we hold a webinar so that everyone can understand the particular deal that we're doing, and how we're gonna improve it and run it. So yeah, I mean, I've got all types of we have all types of investors that get in our deals. So really, anyone can do it. So
So what kind of challenges did you have doing your first one of these? Because I mean, this isn't for your novice jumping in. Like this is something that you kind of need to know what you're doing. So what were some of the challenges that you had when you started up your first one, and how have you changed to where now maybe it's a little easier on you?
yeah, well, the very first deal I tried to do was, I thought, man, I can buy a 20-unit deal. I've owned hundreds of houses.
Mhm.
This should not be a problem. And all of the lenders that I went to said, hey, love your resume, but how many apartment buildings have you owned? How much multifamily have you had? And I was like, well, none, but I own this many rentals in my rental portfolio. And they were kind of like, yeah, you need more experience. So went out and, went to a lot of networking events, and made, built a lot of relationships. And, I found that there was people that were willing to partner on deals. And essentially they had done multifamily deals before, and they had the balance sheet, and they had these requirements that the lenders would like to see, but, they maybe were in a point of their career, or, where they didn't want to be out, doing all the heavy lifting every day, right? And so we teamed up with some folks, and partnered. And so we, found the deal, did most of the sweat equity, raised some funds, and they were also had people that wanted to invest as well. And so we partnered with people and did deals, and learned, different ways to do things, and, just continued building our list over time, and finding success.
So you brought up a good point. So you
Yeah.
went to the bank, and the bank's like, "Hey, what experience do you have?" And so like when you buy your a rental house, the bank doesn't ask. They ask like
Right.
what's your income and what's your credit score and what are the houses worth around it. So when you go borrow money for an apartment complex, it's a relationship as much as it is your bank statement. And so you don't get that relationship easily. You have to earn into it, and you kind of have to run on some people. You have to, ride on somebody else's coattails for the first one or two, which is kind of nice. It's kind of like you're not having your hand held, but you have a mentor while you're going through the process. So it kind of protects the bank, but it's just a
Yeah.
different way of getting in on a deal. Like
Yeah.
it's really fascinating.
Yeah. And you definitely, and it's, these partnerships again can be 3 to 5 years. So you want to make sure that, you have found some mentors, and people with experience that, you want to be in a partnership for a couple years. So, we really found people that aligned with us, and we had fun being around, and that knew what they were doing. So to your point, the bank felt comfortable, and then also we felt comfortable learning, and going through the process. So it's definitely a relationship business. I mean, all the components are built on relationships.
Have you had any banks that had like requirements from you or the property that you didn't expect when you started the deal?
Yeah, yeah, I did. So a lot of the deals we bought in 2018 and 2019 were pretty, easier, right? Like it was more of a relationship. Once we got into like 21 and 22, interest rates started going up, lenders started changing, and then fast forward 23 and 24, the banks got really tight, and there was less relationship. Now relationship is still very important, but there's more red tape. And we closed the deal last month, and one of the interesting about that deal is the lender, it was Freddie Mac. So you can get agency loans, Fannie
Mhm.
Mae, Freddie Mac. And we've done 4 or 5 deals. We have 2 or 3 that we still own. And so we've probably done seven deals in the past couple of years. And so we go to the lender, and we have had some sale, good sales. We've had Freddie Mac loan before, we had good numbers, and we went, and they had this weird guidelines to where it said, okay, you need at least three. They essentially were going to give us better loan terms if we met these three requirements, and they are silly. And one of them was you need to own three deals currently. Well, we owned two. If you only own two deals, you need to own them both for at least 2 years. We had just bought one of them. And then, something like, I don't know, I can't remember the other thing, but I was like, well, at one point we had 700 units in total. We had five deals at the same time. We had this kind of loan. We sold these three deals. We made profit. We bought new ones. And they were like, yeah, but you don't fit in these weird
Yeah, no, is it,
guidelines. And I'm
isn't that
like, what do
wild?
you, and it was, I think it was, their, bureaucratic way of saying, hey, if someone meets these requirements, then they have experience. And so we had to apply for a limited experience waiver, even though, you
You
know,
had it.
we had it, right? And so it was one of those things where it was like, this is goofy. And so it was going to need to be that they do a third party report where they grade the property. And they said, well, the property needs to be an average or better rating. And if there's deferred maintenance, it needs to be less than 10%. And so because in their eyes, anything over that for someone with limited experience would be too heavy of a lift, right? And so, I mean, luckily the property we bought was in good shape, met those requirements. And so we got through these hurdles. But, in my brain, I was like, this is silly, but it's how it goes. So we had conversations, with potential partners that would, join us on the deal in order to overcome that if the property didn't meet those guidelines. But we met it, and it all worked out really good.
I
So
know it's interesting how they send those inspectors out and then they come out with their like this is what you have to do to get funding. I remember as my company, we came in and we're going to manage a small apartment complex in Fort Worth. Great property and everything worked just fine, but they decided that the HVAC units were too old. They all
right,
worked fine, but they just wanted them all new or newer.
right,
My company came in and we changed them all out. And I'm like, that was a very expensive thing. I don't know. To me, it seemed wasteful to replace something when you really didn't need to. But
yeah,
I get it. Is they were trying to keep from having a problem 6 months, 12 months down the road. But I was like, man, that held up closing because they had to change out, I think it was 26 HVAC units
wow, yeah,
just because underwriter decided they didn't like the
right,
Brew or it wasn't Ream. It was like an older model. But it was very interesting. I was like, man, if you didn't have the right team together, they wouldn't have been able to pull the cash together to come over that little hurdle. But fortunately, they had a good
right,
group. But yeah, that's
right.
that's the thing is like you got to know you're on the right team and have it structured right to know what you're jumping into because they throw these curveballs at the last minute because that was like right before closing. It
Oh
was
yeah. Yeah. And it's become more, it's tightened a lot, right? Because, I think that a lot of, especially where insurance has gone crazy. And so because with Fannie Mae, Freddie Mac, and either other types of, relationships, banks, willing to lend on groups with shared experience, you find them, and it's from bank to bank, lender to lender. You find them, sometimes saying, "Hey, this is a requirement from our committee in order to, protect the asset, right?" And so, to your point, like sometimes you got to say, "Hey, like this is in our business plan. We've already seen this. This is what we're gonna do." But I think a lot of times they want to make sure that like the team has the balance sheet, has the liquidity, has the experience so that, you don't have three or four HVAC unit failures and then people move out and then you can't make the interest payment and all of these things. But sometimes it's to your point, like very quirky, where it's like, okay, maybe three of these needed to be replaced, but not all 25, you know. So it's strange.
It
Uh,
was, and that gentleman that ran the GP on that, it was his first deal. So the
right.
bank was probably real skittish. They probably wanted a perfect
Yeah. I mean,
to
that
been
makes
done.
sense.
Yeah.
Yeah.
And they did well. They did really well on it. It was an older property, so it had some strange wiring that we had to jack with every once in a while. But otherwise, it turned out everybody did pretty well on that deal.
Nice.
Yeah. So I'm going to tell you where he went and did other ones after that. First one was very successful. Second one, he bit off more than he was capable of because he raised some money, but he got basically a perfect property, and he had I'm going to say a perfect property manager, which is of
Sure.
course my company.
Was you? Yeah.
And then the next one, he decided he was going to go way bigger,
Right.
and I think he tried to bite off something that wasn't ready to. He needed to do work on it, and I don't think he did a good job. I think he just went with the cheapest property manager. We weren't in the running because we didn't do that type of deal, but
Right.
he ended up taking what could have been a great deal, and it didn't go well when it could have. And I saw a couple of things that he did as a general partner that really sunk his deal when it didn't have to be.
Right.
So I think it's very important to know because when you get a syndication deal, you have your general partner and you have your limited partner. Limited partners, people that just throw in money and they're not doing the work. The GP is doing the work. And I saw from, standing back seeing it, he did a poor job on communicating to his LPs to like, hey, this is what's happening. This is what we're doing. This is how we're going to address it. And then he also went cheap and cut corners on everything he could because growing up in his mind, cheaper is better.
Yep.
And in reality, cheaper sometimes costs you more. And like you mentioned on deferred maintenance or not fixing things, it just becomes a downward spiral and you can't get out of it. And I
Yep.
think that's what hurt him
Yep.
as a result. So we're talking all these wonderful things about syndication deals, but it's super important that you have the right mindset as a GP. And when you're an LP, you want to make sure that that general partner understands the value of the investments and the management and the property conditions. All it's not as simple as throwing some money in it and watching it come back out bigger. So,
Yeah.
hey, give me some examples of what to look for if I'm a limited partner or I want to play the game, but I don't want to risk more than the chips that I have on the table. I just want to put money in on a deal and I want to be the real estate mogul without being involved. I want to be the guy that puts 25, 50, 100K in an apartment deal.
Yeah.
What should I be looking for and what should I be afraid of? What red flags are out there?
So I think that it's similar to a lot of things, right? You're really betting on the jockey, you know, and I think that what's the saying? I'd rather do a good deal with a great GP than a great deal with a not so great
Yeah.
GP. I think that the results from experience is always going to work out better. It's transparency is key, and we do monthly updates with our properties, and we're always extremely transparent. Because I think that that's most important, when you're not hearing from the GP, you start to wonder, oh crap, what's going on? On top of that, in 21, after this giant stimulus that we had, there was a lot of free flowing capital. And so you would see these 40, $50 million deals, and there would be five, six, seven, eight GPs on the deal, and each of them was bringing one or two, three, four, 5 million from their circle. And so you were putting these giant deals together. But, you know, uh, in some, and I'm not saying all of those were bad. I'm just saying, from my point of view, you want to make sure that you don't have too many cooks in the kitchen. And if you do, what are their roles and how are they going to be able to operate, right? I think that the other thing is, the expectation of just coming in and ripping a Band-Aid off and jack and rinse up and, you know, completely lowering payroll is usually not very realistic. Um, and one of the things that, I mean, there are some ways, the deal that we just bought, they had a $3,000 dumpster bill every month, which, realistically should be like 750. So that was one of the things that we did really quick. But I think that, it's important, and I think probably a lot of business owners could relate to this, but, I see a lot of deals, or at least we used to see a lot of deals where they couldn't push rents anymore, but they decided to cut expenses. And I think that, one of the reasons we've been,
We're seeing that a lot right now. That's in
yeah,
families too.
yeah. And I think that you can get into the death spiral with that, right? Like, my opinion is, and has been, I'm a top line guy for the most part, but, if you have a $60,000 property manager on a 100 unit deal, and keep in mind, you have a $60,000 employee that is running a $10 million business, I mean, maybe it, is a million, $2 million in revenue, a year, but I mean, you're somebody's managing that on a day-to-day basis. And I think that, you definitely don't, I would rather overpay that person than try to cut them down, because you really want someone in there. If you have someone, let's say it's a $60,000 position, you have someone in at 75, but they have the skill set to drive an extra $25,000 a month in profit, then, now you've got an extra $250,000 a year, right? So, you really have to be mindful of how you're driving that business to generate profit. And I think that a lot of times we see deals where they started cutting expenses first, and that can really hurt you.
They want to show that they're creating that value or that multiple, and you can't. There's certain things you just can't give up, and to some level, you are a product of your environment. And if the environment's not allowing you to push rents, there is a floor. And I think a
Yeah.
lot of people think that they can just kind of keep cutting, and people won't leave. Or
Yeah.
I mean, because there's other guys that are better capitalized that'll provide all that and weather the storm, and then when it comes out at the end, they'll do better.
Yep. Yep. Yeah. I mean, and that's been really one of the biggest things is people being undercapitalized, and I would rather have excess capital in the bank and not need it, and then, give it back and then get hurt by not having
Well,
enough.
and you kind of briefly mentioned that you just closed a deal, but I think you're still raising capital on it too for that very reason, right? You don't have to have it, but it's always nice to have,
Yep.
which lowers the return but increases the safety of the investment, if the way I interpret it's correct.
100%. Yeah. And I think that right now, a lot of people are looking for that, they still want to make returns, but they want to be in a deal that, has a lot of safety, and I think that, and when interest rates went up, a lot of people had debt, floating interest rate debt. And so a lot of their money went towards interest payments, and then they didn't have enough capital for other problems. And so, now a lot of people, may or may not be aware of that, but, it's like, hey, we've got extra money, and, just in case. And so, yeah,
So I don't want to take forever on this call because I don't want to
yeah, yeah,
beat a dead horse, but let's say somebody does want to get into an apartment deal, but they don't have their network, that their personal network has zero exposure. Honestly, my social network outside of the last few years, I didn't know who I put money with for an apartment deal until you started doing them. Because I didn't,
right.
I mean, I knew of them, but I didn't know anybody, so I wasn't going to do it. So if I'm going to do a deal, I'm going to do it with you.
Yeah,
Like prior to you, I wouldn't know. So
yeah.
how does somebody find a lead that's putting this type of deal together? Like, what would your advice be?
I mean, I think it would just be through channels like this, and then, building a relationship with people like us, like me. Yeah, I mean that's really been kind of how we've built up a good list of investors is, doing podcasts, speaking at events, going to networking events, and
You're doing
a
a good
lot
job
of
of that.
people.
You're doing a good job of that. Yeah.
Yeah, thank you. And a lot of people were kind of there. They didn't really know anybody. And there's been people who I met 3, 4, 5 years ago and just now invested in our last deal. And that's okay. They wanted to make sure that, what we were pitching was actually happening. And also, integrity is huge. And, if a deal's not going good, relaying that information and what we plan to do on it. And, our reputation is extremely important. Once tear that down, it's hard to build back up. And, I think for us, it's always been really important to make sure that we buy deals that we believe in because we want them to be successful because I've got my own money in it and we treat every deal as if it's all of our own money because most people that invest alongside us are friends and family, so over time, most of the people that I know and I, talk to frequently have invested with us. And I don't want to see anybody lose their money. So, I think that transparency is key. And I think really finding someone, that, has integrity to do the right thing and be transparent about it. I mean, I think that I know some people out there who I've asked how their deals are going and they say, oh man, everything's great. And I know that some of their deals are not going good. And I think that like for me, and I think that for most people, saying, hey, like here, this deal is here's the struggles. We're having to dig out of a hole and come around and, this, that, and the other. And I think that shows a lot of, again, I'll say integrity, but like, I think for most people say, okay, like, I can trust this person.
Well, I think you're hitting a good point, and I think what it is culturally, people are afraid to talk about money.
Right.
And I grew up in an environment where it was okay as a family to talk about money, but I mean, you don't talk about it to your neighbor.
Same.
And I've seen that in my own neighborhood, like even like Cub Scouts, and like nobody talks about their investments or what's working or what's not working. And so there's not a hey, let's share and like or anything of that nature. It's
Yeah.
everybody, I guess it's insecurities or keeping up with Joneses. I don't know. I'm a little different because I was in that financial service industry. So I had to talk to people all day long about
Yeah.
their money.
Same.
Like, hey, where's your other 100K? Or what are you doing
Yeah.
with this? Like, yeah, I had to, it was very uncomfortable for the first year. But after I got out of that and where being uncomfortable, talking uncomfortable topics about personal money was comfortable and normal, which it may make people uncomfortable around me,
Yeah.
it doesn't bother me. So
Yeah.
what people need to do is learn to have uncomfortable conversations with people. And it's not because you're trying to measure yourself against somebody else, but you're learning. Every time you talk about something, you learn from somebody on what works or what doesn't work. I was at
100%.
a get together with some fraternity brothers that I from A&M, and we talked a little bit. I knew one guy was doing some energy stuff, and so man, I got to pick his brain, but I
Yeah.
didn't have anybody else to talk about that kind of investment with anybody. But I had a relationship. And so you just have to broach those topics and like ask awkward questions. I think people will appreciate that, honestly, because we live in a world where people just want to talk about real surface. Like,
Yeah.
man, Notre Dame, why didn't they beat Ohio State?
Right.
Like my life is ruined now. Like it's really it doesn't go real deep. And
Right.
instead of having real conversations of like, hey man, like we have real like this real thing happening, or
Yeah.
hey, I'm 47 now. I've got 20 years until I am at the normal retirement age. What am I going to do? Like, what am I doing to be ready for that? And I think when people start having those real conversations, I think they'll learn from each other and more opportunities will pop up.
Yeah. I agree. 100%.
Yeah. And I know my income and net worth has gone up just by having more conversations because our mutual buddy Ed, like he's the one that introduced us because we had
Yeah.
like minds and we had those conversations because to him and I it was normal to talk about
Yeah.
investments. So he's, oh, you need to meet my buddy Jimmy. He's flipping
Yeah.
houses and blah blah blah. And he mentioned that for probably a few years before we ever really got to connect.
Yeah.
But like you opened up my world more to syndications, and as a result, I've kind of dabbled in that also. Just I don't do
Yeah.
apartments, I do single families. So it's I think people really need to get comfortable with being uncomfortable.
100%. And I think you're right. I think most people get comfortable and then, don't reach much further.
Yeah.
And I mean, my path was similar. I was in home loans
Mhm.
during the last recession. So as rates were going down, I was in a call center pitching refis. And so before I got into that, yeah, I came from the same place, not used to talking about money. And then after those 3 years, I just would ask people all the time. And then sometimes people would look at me funny and be like, oh, I guess I forget. Not everyone talks about money. But
Yeah.
yeah, I mean, once you are the five people that you hang out with. And if you're in, with five people and y'all are all talking about money, I guarantee you everyone in that group net worth will,
Yeah.
push.
Yeah,
So
I can say that for a fact. I've gotten real good buddies of mine that I meet up with pretty regularly, and
yeah,
we share knowledge. I mean, I think you mentioned Jason earlier, and he's been on
yeah,
our podcast. Is I've bought deals off of him. I think he might have bought deals off of me. I've got some other guy like, and it's all like we help each other, and we're all
yep,
making money the whole time. So it all
yep,
works. So I think people really do need to like step out. If you don't know somebody that's putting together deals like Jimmy, you do know somebody that's doing something that may not be Jimmy, but they're in that direction. So for me, like my office, we deal with investments all day long. We property
yep,
management, we got realtors that help people buy investment properties, but these people know the Jimmys out there and can kind of put you in the right circles or keep you in mind when something pops up. Like we've got a client that had a portfolio of crap, what was that? 70 something houses that we brought on. I can't remember. It was a lot. And he brought it on solely to sell them. Like he just brought us on. He's like, hey, come up with a business plan. Let's strategically unload these 1031 of these into others. And then so
right.
we've got one dedicated employee. That's all his life is right now is working through this gentleman's portfolio. And he gets real analytical about it. It's amazing. But you know, you got to visit with people that are accustomed to that type of environment. So I'd encourage people to reach out to not just a real estate agent and not just a regular property management company, but one that's like really knows it and understands it. There's a handful of property managers out there that have made some serious money in owning real estate. Those are the ones to talk to. There's the guys that, have done some syndication deals. I would say talk to somebody that's done a few of them. So I think that's where we need to kind of start pushing people towards
Yeah.
instead of
Yeah.
max out
And
the
I
four oh
think
k.
it's, and I think it's one of those things where, at some point you gotta step in front of your ego, right? Like I think that there's, people have these goals, but they're not there yet. And so, saying, hey, like, here's how much money I'm making, here's what I have in the bank, like, how can I get to the next step, right? And
Because they're afraid to let people know that they're not a winner. And I'm,
yeah,
hey, man, I was borderline broke for a long time.
yeah,
But I talked to people and read books and listened to podcasts and watched videos on people that were steps ahead of me. And I'm like, what steps do I take to get to there? And I think people need to take more control. And I think what it is, there's a lot of people out there, and I've run across a ton of them that they just thought that it's harder. And this is my tenants that don't think
yeah,
they can own a home.
yeah,
They think it's not possible, or they think
yeah,
it's not. That's for the Donald Trumps, or that's for the Bidens. That's for these other people. That's not for me. And absolutely every single person, I don't care if they're working at 7-Eleven or if they're working like big sales rep at some big corporation. Like everybody can make those steps. I've I've heard stories of people that are, oh, that Lifestyles Unlimited group that helps people
Yeah.
put houses together. There's a gentleman there that was his profession is he was in the orchestra in like Austin or something, like
Oh,
25
wow.
grand a year. But he was in after a handful of years, he was able to make more money in real estate
Yeah.
than he was doing orchestra, and he got to still do the orchestra.
Yeah.
So
No,
there's
I
another
love it.
gentleman that he just recently passed, and I can't remember his name offhand, but he had several palsy, so he was like in a
Oh,
wheelchair,
yeah.
can't even really access properties very well, but he made a completely good living on real estate investing because of his network. So, yeah.
Yeah. Yeah. Yeah. No, I mean, I was the same. I read Rich Dad Poor Dad in
Mhm.
college, and it really changed my life. And what I've come to realize, not always true, but I think there's a lot of regular guys like us and like the listeners that, probably have a lot of investments that are making a lot of money. I mean, I tend to put my money into assets. And there's people that are, making $900,000 a year salary, but they're living a $1 million life. And so, they may have the big house and the big car, but they don't have any investments, so it's not always, what appears to be the richest guy in the room. A lot of people, are buying stuff, which, all I'm saying is that you can do it too, right? Like that's what made me feel like, oh man, like, you know, Kyle, we're alike. He did it, so I can do
I'm a
it too.
loser and I did it. Yeah. No, there's an awesome kid in Austin, and he's got a podcast or a YouTube channel or whatever. I think it's called School of Hard Knocks. Have you
Okay.
seen that? You need to watch him. And
Okay.
he just goes out and visits with anybody that will talk to him. It's like, hey, how did you get rich?
I
It's
think I've seen that. Yeah.
very short clips,
Yeah.
but
My buddy was on an episode of that.
I, there's well, a huge portion of the people he talks to end up being they made their money in real estate or
Right.
they made really high income somewhere, but real estate's what skyrocketed it.
Right.
And almost all of them are business owners. But those are fascinating to listen to. But it's these people, they made a decision somewhere in life that they were going to take control of their situation. And it's either by, starting to do like syndication deals or stepping out and owning the business or owning the investment as opposed to just kind of renting. So,
Yeah.
you know,
100%. Yeah. I mean, it's an anybody can do it game. You just got to believe in it and
not for the
grind it
weak.
out. Huh?
It's not for the weak people. That's
Yeah.
for certain.
Yeah. Yes, agreed.
Yeah. Well, Jimmy, I really appreciate your time. I'm gonna include, if you would email me, include like if there's a link to like
Yeah.
your stuff,
Yeah.
and if it's something appropriate, I'll definitely refer people to kind of keep in touch
Yeah.
with you, LinkedIn wise or whatever, because
Yeah.
I think you're
Yeah.
good for some
LinkedIn. And then our website is High Five Multifamily. It's the name of our company, high5multifamily.com. Yeah, I'll give you the info so you can put it below. But yeah, I mean, I answer the phone and respond to texts and all the things. So would
Just
love
don't
to
tell
meet.
him Kyle sent you. He might not answer. No, but no, man, I really do appreciate you sharing your knowledge and I know you're busy because like when you were talking about being transparent, I know you're very transparent with your investors because
Yeah.
you miss out on a lot of things that I try and invite you to. You're like, no, man, I got a conference call with my property managers on these deals, and
Yeah.
you take it serious. You're not just sitting back trying to make dollars. You're trying to be communicative and on top of it, management such.
Yeah. Yeah. I appreciate that. Yeah. And thanks for having me.
Absolutely, man. Love it. All right, well, man, have a good one. Good luck on this deal that you got going on right now. I want to hear all about the wins on it, and
Yes,
then
sir.
I'll always come to you for advice. I appreciate it.
Thank you.
All right, have a good one.